Hey everybody. So check this out. This is a real life example of our modern platform. So this is just a couple. I've got two client statements pulled up, a more average sized account and a larger account, and I want to just kind of bring this to life. And it's very simple. This is not complicated. This is what your client would have as an experience. They would open up their statement and have individual stocks and bonds in their portfolio if the account's large enough, which would be, let's say, a household of $500,000 or up. $500,000 and below, all these same concepts apply, except we would be using very, very low cost ETFs in the portfolios. So anyways, if you really just, this is like I said, a really, really simple concept. We, Revisor, are acting in both what you would normally call the TAMP capacity and the micro manager capacity, or SMA manager, mutual fund manager, ETF manager. So we're doing both of those handling both of those functions for an average of 50 basis points for the two combined. The average TAMP right now in the space that operates very inefficiently is charging about 45 basis points just for the TAMP side of the equation. So that's where we've pulled the majority of the expense out of this, antiquated system that we're in right now, the supply chain, if you will, of how investments funnel from the starting point, if you will, or a portfolio from the starting point to what it looks like and what the cost structure is when the client actually experiences it. So this particular client got their name removed here, but this is an actual account. You could charge, let's say you charge 1%, then your client can be all in trading expenses, all fees included, everything from top to bottom for 1.5%. And if you compare that to the norm, especially when you look at the cost, the internal trading cost, most advisors are not familiar with that part of the equation. If you're listening to this and you're not familiar with what I'm talking about, there's a link in this article, the article that you probably brought you to this video, the link that defines and gives a lot of information on total cost, all the costs involved in a portfolio. And if you're not familiar with the implicit and explicit trading cost, I would take a quick look at that. But we've scraped so much of that cost infrastructure out. Now, there's one little philosophical thing here that I'll mention, which is, and as I am, I'll kind of scroll down so you can see we are using a Bloomberg terminal, and we're doing the individual stock picking. Okay, so we're picking the individual stocks and bonds. If it's smaller accounts, we're basically trading low-cost ETFs, but any type of active or fundamental type of component that would management style that would be involved, we are doing that on your behalf as we do the TAMP functioning, all the trading and model design and all those things. So you normally have 2% or a little higher in the industry is the average when you take a lot of times mutual funds or SMAs, look at the internal expense ratio, add in the implicit and explicit trading cost. So we've scraped 1.5% or so out of that cost structure. Now, the philosophical thing here is that, in my opinion, if you pay a sub-advisor, if you pay a TAMP, in our case, let's say it costs about 25 basis points, the industry cost about 45. If we charge 25 basis points, from my perspective, that's money you would be spending to do this yourself. If you use a TAMP, you don't have to buy your own trading software. You don't have to buy performance reporting software. You don't have to employ people to do research, analytics. You don't have to employ people to trade. You don't have to employ people to do any of those things. 25 basis points is the average cost in the industry for a firm to do it on their own. So it's not costing you any more to outsource this to us, that it was done that way by design. We had to figure out a way to make money, to have some profit, a small profit margin when charging the same cost that can be emulated if an advisor builds their own platform in-house. When a TAMP charges 45 basis points, that's 20 basis points higher than what it costs the average firm owner to build all this infrastructure themselves and do everything themselves. So that cost is there by design, but that cost, in my opinion, if you normally would charge a client 1%, then you would eat that expense. But a lot of advisors don't do that. They basically say, no, I want to make 1%, and then I'm going to basically pass on the TAMP expense to the client, which fine either way, however each advisor wants to do it, to each their own. But in this example, either one of these accounts, actually, the client would be all in, everything from top to bottom, total cost. This is just another individual stock portfolio where, again, it's not just a bunch of random stocks. We're picking and doing the micro level management there, and doing so with very low, extremely low trading cost, implicit and explicit, and very low management expense compared to what we have in the industry now. So if one way or another, if you pass the TAMP cost onto the client, then they'd be all in this case at 1.5%. If you eat the 0.25% cost to outsource all the trading and model construction and billing and all those things, if you decide to eat the cost, then they'd be all in at 1.25, maybe even 1.2. Depends on the size of the account and all those little variables. But that's how this comes together. That's what it looks like in real life. If you look at the average statement, and you see mutual funds and ETFs, and there's a TAMP that's outsourced to, and you add everything up, at least 1% higher than this structure, a lot of times 2%, but somewhere in that 1.5% range is the average total cost savings in this new model that we've created. All right, that is it. Have a good day.